Market participants are looking for an immediate result. They chase the algorithmic shortcuts and the overnight gains, constantly refreshing their screens in hopes of a sudden jump. But building enduring wealth looks like agonizingly slow repetition. It looks like Warren Buffett, a man who holds one of the largest personal fortunes on Earth. For decades, other investors mocked his approach. They focused on quick profits, while he sat still. His method lacked the immediate rush of day trading, and to many observers, the strategy appeared stagnant. He built his empire through a sequence of calculated decisions that required extreme emotional discipline and a willingness to wait decades for a result. To understand how a few dollars grow into billions, we have to look closely at why human beings are so poorly equipped for long-term waiting. That waiting started early. At just 11 years old, when his peers were figuring out how to spend their allowance, he purchased his first share of stock. While other children were playing, he spent his afternoons reading books on finance and studying the underlying mechanics of how businesses generate cash. He realized early on that tracking daily market trends was a distraction. He chose to prioritize long-term horizons over the noise of short-term volatility. He mastered the machinery of capital long before he ever attempted to spend it. This practice is called value investing. It requires stripping away the hype to analyze a company's business fundamentals rather than trading its ticker symbol. His mandate was to find companies that dominated their industries, buy them at a fair price, and commit to holding those shares for decades. You can see this strategy in his accumulation of massive consumer monopolies. He bought millions of shares of Coca-Cola in the late 1980s and simply kept them in the vault. He expanded that strategy into foundational global businesses, pouring capital into major financial institutions and deeply entrenched regional banks. In this view, value comes from owning a piece of enduring market reality, a business people rely on every day, rather than trying to time a price fluctuation. The test of this discipline arrives during market crashes, when the floor of the New York Stock Exchange descends into panic. While the general public's instinct is to sell off their assets to stop a perceived loss, Buffett remains stoic. He views market dips as opportunities. To him, a crash is a chance to deploy more capital and acquire productive companies while they are on sale. Maintaining strict emotional control when the market is screaming to sell allows an investor to accumulate assets while prices are at their lowest. This graph tracks time versus wealth, visualizing the mathematical core of his fortune, compounding. For his early decades, the trajectory of his gains sits stubbornly low and flat. This horizontal stretch is where most investors quit. The daily gains feel invisible, and the repetition provides no immediate gratification. Eventually, the math hits an inflection point. Those tiny, repeated gains multiply against each other, pushing the total into the billions. That mathematical reality is the foundation of his corporate holding company, Berkshire Hathaway. It's a financial empire built on repeating small wins over 70 years. Compounding is the force that takes linear patience and transforms it into an exponential reality. Today, the scale of that patience looks like a stadium filled with tens of thousands of shareholders, all gathering to hear from a man who simply waited for the math to work. Despite achieving global financial dominance, his personal lifestyle remains simple. He lives in the same house he bought in the late 1950s. His success relies on avoiding unnecessary risks. Because a single major loss resets the clock, he protects the compounding cycle at all costs. This scale of wealth is what happens when a specific strategy and rigorous discipline are allowed to run uninterrupted for 3/4 of a century.